Good morning, everyone. My name is Eloise Hall, Head of National Accounts here at Kensington Mortgages, and welcome to our latest webinar explaining the inner workings of the mortgage industry. We'll be discussing some of the hot topics of the industry this morning that aren't often explored or talked about. We've got over 1,200 mortgage brokers set to join us this morning, so thank you so much to each and every one of you for taking the time out of your day for us. As our regular attendees will know, these webinars are developed on the back of your feedback. So please do get involved and submit your opinion after the session today and let us know what you'd like to hear about next. But before we get into the agenda, I'll just run through some brief housekeeping tips for you. The first thing to mention is that on your screen, you will have a control panel. Within that control panel, you will find the option to submit questions throughout today's session, and my colleague will be on hand to answer those for you. If you come across any IT issues, please do utilise the same function and get in touch, and we'll work with you to try and resolve any problems. But classic IT tip that we found is to simply log back out and log back in using the same webinar link, making sure to select computer audio when you do so, as you won't be able to hear parts of today's webinar if you have not selected computer audio when you've logged in. We'll be emailing out your CPD certificates after today's session, and as we expect to run to around 60 minutes, your CPD certificates will reflect this as well. So to make sure we keep to time this morning, let's get started with the day. So we've got a great lineup planned for you. First up, we have William Hobbs, MD and Chief Investment Officer at Barclays, who will be joined by Francis Cassidy, Head of Strategic Partnerships for Kensington and Barclays, and they will be discussing the global market outlook and what this impact has in the UK. We'll then be showcasing an interview with Kensington's Capital Markets Director, Alex Maddox, who will be discussing the inner workings of the Bank of England's Monetary Policy Committee and their impact on the market and what might be happening behind those closed doors. Our next interview will be hosted by Adam Sheldon, National Account Manager here at Kensington, and he'll be joined by Andrew Montlake, MD of Coreco and the Chair at AMI. They'll be discussing the broker impact in the market and his role within the governmental meetings and the Martin Lewis Show. And last up, we have Francis Cassidy back on screen to give you the latest Kensington news. But first up, please let me welcome Will and Francis onto your screen. Over to you both now.
Thank you very much, Eloise, for that introduction for myself and for Will. And thank you, Will, very much for joining us today on your first Kensington webinar.
Oh, it's a pleasure, Francis. Thank you for having me.
No, you're more than welcome, more than welcome. So it goes without saying, since COVID, which was coming up to 4 years ago now, we've been in a very unpredictable time for the world economy. As interest rates are approaching peak levels and we're seeing inflationary pressures start to wane, it'd be really good to get some insight from you, not just globally, but the UK specifically on what's going on, trends, and what we can look forward to in the future, I guess. So if you're happy, we'll crack straight on with a quick tour, if that's even possible, of the global economy at the moment.
Yes, tell an economist to be quick, honestly. Yeah, I'll try and stop me, honestly. But no, you mentioned all the major points there that are relevant, really. I mean, the global economy, like the UK economy, is still really shaking off the, COVID, the after effects of COVID. And it's not just the disease itself and the effects of lockdown, but all the policymaker responses and the inflation that came along afterwards. Obviously, that was helped along by, war, tragic conflict between two of the world's most important commodity producers. But you rightly say that it does look like inflationary pressures are starting to peak, peaked in some places. And that hopefully should herald the peak in interest rates. If you look around the world, though, it's a very sort of it's not one story for all, obviously. The US economy seems to be motoring ahead, which is really, surprising many people because, the US, like the central bankers here and in Europe, the central bankers in the US, as near a damn it, sort of would try to put a brick wall in the path of the economy by raising interest rates sharply to slow the economy, to bring inflation to heel. The US economy just seemed to crash through that brick wall and it's still sort of motoring. There are some signs sort of weakening here and there, but the US economy really does stand out. And that's really important for the global economy, the UK included, because the US economy very much sets the beat. It's by miles the most important capitalist economy out there. And that sort of sets the tone for the rest of the world and the world's capital markets. Elsewhere, it's a very different picture. I mean, Europe has been slowing quite sharply, looks to be swooning a little bit in terms of activity. And China has been having its own problems, domestic problems with this, the popping of a giant, epochal property bubble.
And do you think we're going to see any of the China's residential property market goings on reverberate globally and to the UK?
Well, I mean, it's difficult to say, obviously, and I'm sorry, economists always say, like, on the one hand, on the other. I think it was President Truman who said, for the love of Pete, give me a one-handed economist. But the story of China property is really extraordinary. I mean, if you think, the Chinese economy over the last several decades has been one of the success stories of the global economy, huge reductions in poverty rates globally and in China are owed to this kind of massive development story. And at the heart of that development story, China has transferred about 500 million people into cities from the countryside. Now, I think the statistic I heard the other day is that at 3 years during the 2010s, China poured more concrete into the ground than the US managed in the entire 20th century. So this story is enormous. I mean, it's really unprecedented in terms of sort of a construction boom, but that story's over. And you can't really urbanize twice, obviously. You can just do it once. So now they need to find new growth engines. And so it does feel like China's role in the global economy, its demand for commodities, all those kind of things, that is going to change quite markedly going forward. So yes, there will be reverberations. We want to be careful. I mean, I would generally go by the rule that the greater the confidence someone tells you what's going to happen for the rest of the world from this Chinese, slowdown, the less you should trust them. So keep an open
we'll
mind.
take your word.
Yes.
Brilliant, thank you, Will. And coming to the UK specifically, are there any trends at the moment that you think it'd be good for intermediaries to know so they can start helping their customers?
Yes, I think no. I mean, there's a lot going on with the UK that's really important. And I think, it's been an incredibly challenging time for the world economy this last few years. The UK has got some extra stuff, and it's in tray, some more homework, if you will, to sort of chew through. Part of that is, the sort of Brexit story, the renegotiation of its trading arrangements, all the sort of uncertainty and unsettlement that comes with that. That is sort of creating in some people's minds a slightly slower economy with a bit more inflation, and therefore that means that people are worried a little bit that interest rates have to be there's a different story of interest rates here. And people have been getting very gloomy about the UK for a while. It seems to be there may be an element that we Brits, we love to we love to whinge about the economy. We love to look down on the world, don't we? It's part of our national sort of national characteristic, our stereotype. I wouldn't get too gloomy. I mean, I do think the UK economy still has a lot going for it. Remember that, what doesn't get talked about at all, really, in the kind of day-to-day economic debate is the quality of institutions. And yes, those institutions have taken a bit of a battering in the aftermath of Brexit and some other stuff. But we still have kind of world-envied predictability for the most part. That idea that, the rule of law and various other sort of structures embedded in the economy, those still are, I think, very competitive relative to many areas around the world, and should, once the dust settled a little bit from some of these renegotiations associated with Brexit, should be attractive for investment. There is also, we've got a number of areas, I think, for the UK economy where we have strong comparative advantages. So people talk about biotech as one area, financial services, self-servingly, is another. That's one where we've had a comparative, an advantage for many, many centuries, to be honest. So don't get too gloomy on the UK. Yes, there is some tough stuff to sort of digest, I think, in the next few years. But there is this incoming technological revolution, in the form of, large language models, AI. And that really is a chance to sort of catapult ourselves into the next paradigm and move out of this period where, we've had slow growth in sort of productivity. It's been a difficult period for the UK economy, full stop. So hopefully, I'm an optimist, but I do think that sort of, better times are coming. But in the short run, we've still got this kind of interest rate headwind to digest, and the UK economy is uniquely almost kind of exposed to kind of mortgage rates in a way, because of the way that mortgage rates are sensitive to short-term interest rates versus other areas where it's longer term. Sorry, there's a lot, but you see what I mean.
No, that's really good. And I think if I had £1 for every broker that told me that when they have a new customer come in and speak to them, they're asking, what do I do? What's going to happen with interest rates? Do I go for a 2-year, a 3-year, a 5-year? What does that look like? Do you have any view on that?
I have loads of views on that. I'm not sure they're for public consumption. I mean, we've all got our own decisions on this front to make. Again, be wary of sort of overconfidence, because if you look at you will know, there's a curve of future interest rate expectations that you can see in the market, and what it basically plots is the path of expected monetary policy, and it should go, at the moment it sort of curves up like that and then goes down again over long periods of time, saying that interest rates will eventually be cut back to a certain normality. However, in a sense, looking at that curve over the last 2 years, it's kind of been body popping like a breakdancer. It's been all over the place, hasn't it? And quite unpredictably so. So be wary of being overconfident. I would say that at the moment it looks like, because you're somewhere near the peak in interest rates, going a bit further out, if you're able to, you should be able to access slightly lower interest rates, but it's very much, as you know, it's dependent on your own situation. There's so much that goes into these decisions about where to put your money and how to borrow and so on, that you want to be very wary. And this is never a personal recommendation, but hopefully near the peak in interest rates is what I would say.
Okay. And that's hopeful, right? And I think that would be quite comforting for a lot of people to hear, whether we're right or wrong at this point.
Yes.
So
humility is appropriate, like you say.
Yeah, definitely. So big question, I know this next one is around recession. Do you think we can avoid it?
Yes. Now, I do think we can, but I think you've got to think about these things again probabilistically. So, in a way, a lot of the sort of media debate is about you will or you won't. There'll be a recession or there won't be a recession. And in a way, there's all sorts of shades in between of sort of minor downturns, surfing along the bottom of the gravel pit, that kind of thing. And I think it's, in a way, we don't want to be too reductive about it. So, yes, I mean, in a sense, like this has been the big debate, not just in the UK, but globally this year, that there must be a price to pay for all these interest rate rises. And they have gone up so sharply that, generally you would expect there to be a rise in unemployment and therefore, a recession to a certain degree. And that's part of the intention to a certain extent from central bankers. That's why they don't face the electorate. That's why they sort of, they have mandates outside of the electorate to a certain degree, because we want them to do an unpopular job. However, there are mitigating factors within the UK economy. So, if you think about it, we talked about a lot of that mortgage debt in the UK. Well, that matches up. So a lot of the people who are having to, not all unfortunately, but a lot of the people who are having to stomach sharp increases in their mortgage costs, they're also the ones who've got quite a lot of excess savings accrued, those same households, excess savings accrued from the pandemic. So that there's a kind of, there's a match up, which is a little bit helpful in terms of sort of avoiding a recession. The other thing I think is just, and you're seeing this in the US, is that, there is this kind of growing investment into, AI and AI related software. And that, again, that could, if that spreads a bit more broadly, that could help, get the economy off the kind of baseline. So, yes, I mean, I don't think a recession is an absolute certainty. There could be one, but I wouldn't get too focused on that. In a way, we can't really avoid that. I don't think, and I want to be quite careful here, that there's a huge rise in unemployment due, or there's big bubbles to be popped here and there in the UK. But there are a number of things we need to do to sort of get the economy moving in the right direction again. which, yes, we must hope for, I guess.
Yeah, absolutely. And that's brilliant. Thank you, Will. That's actually all my questions, but I'm just going to ask one more if you don't mind. Just for the brokers listening into the webinar today, would you have any top tips when they're speaking to their customers? There's so much going on at the moment. Is there anything that you would say to a broker that's great to kind of relay to their customers?
Well, I mean, it's always difficult to know exactly one thing, but I mean, I guess, you know, the difficulty, I mean, I think in a way, like, the one thing you don't want to get too caught up in doing is kind of second guessing the direction of interest rates too much. You know, we know less about the path ahead than we think we know. That's just always the case. You know, we are in particularly uncertain times, but that's always the case. But,
yeah,
you know, most of the time, you know, the media and various other kind of purveyors of information remember that their incentive is, you know, to provoke outrage and attention. That, you know, the various kind of feeds are greedy for our eyeballs, and our eyeballs tend to respond to one thing, and that's kind of, you know, tragedy or outrage or, you know, something on Kerry Katona. And I think in a way, like, the story about what we're looking to do is different in a way. Is if you think about it from a, you know, a house purchase and those kind of angles, it's a much longer duration purchase, isn't it? It's, you know, you're not looking for the world as it is right now. You're looking at the world as it might be in 20 years' time. And just remember, on that time frame, you look back over history, you know, even if history is not a perfect guide, progress has tended to be the norm. Remember, the UK kickstarted progress, really, or economic progress back a few hundred years ago. So, you know, don't get too bleak on it all. You know, I don't think these interest rates will stay quite at these levels for very long. I don't think we're going back to the 1970s. I think the central bankers have learned the lessons of that period. So we are better equipped. So yeah, just, I think, focus on what you can control to a degree, which is the interest rates that are currently available and the curve that is currently available, and act accordingly, and steer clear of kind of doomsday scenarios. Most of the time they're not true, or not.
Brilliant.
We hope.
That's great. And you know what? That's a great place to end there, Will. Thank you so much for your time today. We really, really appreciate it. And hopefully we'll see you again soon.
Thank you.
Thank you, Will, and thank you, Francis, for that really excellent insight, really putting the global markets into perspective and giving a very positive outlook for the UK, which is great to hear. Next up, Francis and Alex Maddox, our Capital Markets Director, travelled to our head office to discuss the inner workings of the MPC, the Monetary Policy Committee meeting. So let's give that a watch now.
Thank you very much, Eloise, and thank you, Alex, for joining me today in real life, which is lovely.
Thank you for the invite.
Very welcome, you're very welcome. So it's fair to say that the MPC have made more interest rate changes in the past 6 months than they have in the past 6 years. So in this session, what we really want to get behind the scenes of is who the MPC are, how they make decisions, and what impact this has on the market. Secondly, from a consumer, broker and lender perspective, what all this really means in practical terms for the next few years. Great, are you ready to crack straight on, Alex?
Indeed.
Firstly, simple question, what exactly do we mean by monetary policy?
So, well, monetary policy is the way in which the central bank try to impact inflation. Also, in other countries, they also can focus on unemployment rates and growth and the risk of recession. And what you'll also see in some sort of developing economies, a desire for price stability in terms of the exchange rate as well, trying to make sure that there aren't a lot of inflows or outflows from the country due to exchange rate volatility. For example, in Argentina recently, there's been a lot of talk about them trying to control the exchange rate through changing interest rates. But for the UK, they are primarily focused on inflation. That's their key goal they have to go for.
Brilliant. Okay, and we'll come back to inflation, absolutely. Let's talk about the actual committee. So there's been some changes recently. Who are they and how are they made up?
Yeah, it's probably the most public-facing part of the Bank of England, and the Bank of England has an awful lot of different functions, but the MPC is the one that meets on a regular basis, not quite every month during the year, but pretty much. And they, as I say, they're probably the preeminent committee as well. So they're made up of the governor and then 3 deputy governors. So the governors may be the ones that focus on price stability or markets and risk management. Also the chief economist of the Bank of England. So they have their own chief economist who, as you can imagine, is picked from some of the best economists across the globe. And then also there's 4 external members who are picked actually by the Chancellor of the Exchequer. So overall it's quite a broad committee. They will all vote on what they think interest rates should do, and if there's ever a tie, the governor has the casting vote. So it's a mixture of long-term staff members as well as these external advisors. But these people come in with the highest credentials as you might expect. They don't all have to be British. Carney was a famous Canadian, I think, Bank of England governor. So they can be from anywhere, but obviously an incredible pedigree an honour to be invited to be on the Monetary Policy Committee.
Yeah, absolutely. And I'll come back later on in the interview to talk about the different decisions that they make within the party. But before that, can we talk about the tools that the MPC use to achieve its objectives and what those objectives are?
Yeah, the primary tool which they have is the Bank of England base rate, or as we all say, the base rate. They do, I'll talk about what that is and why it matters in a minute. They also have a couple of other tools like quantitative easing, or QE, and quantitative tightening, which is the opposite of QE, or QT. And quantitative easing is something we saw during the global financial crisis, also seen during COVID. And what that broadly means is they will print money and add liquidity to the banking system. Some monetary policy does focus on money supply, but it's less popular nowadays than it used to be. But in particular, quantitative easing is where you print money and you provide an awful lot of liquidity to the system, and I'll talk about why that's important perhaps in a bit. But the primary focus day to day, or the primary tool day to day, is on the Bank of England base rate. And what this is, it's the rate at which banks and building societies can deposit their cash overnight with the central bank. So, the very large UK banks will have hundreds of millions of pounds deposited overnight with the Bank of England. And what they will look at is the rate that they charge investors on lending, or the rate that they give investors on savings, will be very closely linked to what the rate is that they can get from the central bank. So if I'm a big bank and I've got £1 billion worth of deposits that have come in from my consumers, the bank can choose to put that money with the Bank of England. And if the Bank of England is now offering them 4% instead of, say, 0.5% of where it was, that means that the bank can give the consumer a much higher rate on their savings. So there's pretty much one main tool they use, but it's pretty impactful. And I think the reason sort of why that works is probably an interesting one, because what they're trying to do is to get consumers and businesses, actually, because it works for both, to either spend more or spend less. Because if you're trying to target inflation, if you're a saver and you can go and put your money in the bank and get nothing, then you're going to say, well, what's the point of putting it in the bank? I might as well either leave it under the mattress, or I might as well go out and buy something nice for myself or my family. And then that is obviously going to increase the amount of demand in the economy, and that can push prices of goods up. And it's the same with businesses. If they can get there's no point in leaving money in the bank for a rainy day. If you think you'll get no interest on it, you might as well try to put it to work in terms of capex. And the same with lending rates. If lending rates are much higher, then consumers will feel somewhat pinched. We've been talking about the cost of living crisis. That comes from the inflation side, but also what happens is if mortgage rates are much higher, consumers just have less available cash, and that means that they'll spend more on goods and services, which means that over time the price of those goods and services should moderate, or there shouldn't be as much pressure for them to increase. I think the key issue is how much does the central bank rate really, or do those rates for the consumers really impact their spending patterns?
That's really great information, and I think a lot of brokers ask these questions and don't have anywhere that they can go and ask these things. So this is brilliant information, so thank you. So let's talk about the challenges facing the MPC in the current environment at the moment. Can you talk a bit around that?
Yeah, I think these are very uncertain times, and we've been pretty much on a 10-year journey where someone described it as I've seen an awful lot of once in a lifetime events in the last 10 years, and whether it's the global financial crisis or a pandemic or a war in Ukraine, these are very large events that the central bank is having to react to. More specifically, in terms of the base rate impact, what you often hear people talk about is the transmission effect, and what that means is, if the central bank puts up rates like they've done recently, how impacted will consumers and businesses be by that change in rate, or how impactful is it? And where that sort of can change, an example of where this will change is, and this has been talked about a lot in the mortgage press recently, is that if all customers are on fixed rate mortgages, and those are all 5-year mortgages, because the customers lock those in at 1 or 2%, then it's going to take a while for interest rate increases to actually affect those customers. They're in a great position because they've locked in a nice low rate, and it would be a lot more expensive to go right now. But for the central bank and the Monetary Policy Committee, they want those customers to spend less money on goods and services, but those customers aren't being impacted by the MPC's actions. For those on floating rate mortgages, obviously they'll feel that straight away. And then I guess the other thing is that an awful lot of the UK own their houses outright. So I think about the data is like a third to a half of properties are owned without a mortgage. So putting up mortgage rates doesn't impact the consumers that own those properties. However, those consumers probably are more likely to have savings, and therefore they're going to be incentivized to put their money in savings accounts rather than go out and spend it.
Yeah, definitely. And I think we're seeing a lot more of that data come out in the market at the moment. So it's really good for context for brokers and speaking to their customers. So we spoke about inflation. We have a 2% inflation target, which is considered good. Where's the target come from? Why is it a good target?
It's a fair question, actually. And why 2%, not 1 or 3 or anything? I mean, I think everyone knows that deflation is bad, so that's the risk of inflation going below 0. And the reason why deflation is deemed to be bad, although some of us might like the price of things to go down. It'd be quite nice when you're going to the shop the next time for what you want to buy is actually cheaper than the last time you went to the shop. But actually what it does is it will encourage consumers to postpone purchases of goods or services, and the same with businesses. If they think they can buy that TV 5-10% cheaper in a year's time, they'll probably stop spending right now, and that can have a very negative impact on growth. And that's why deflation is deemed to be bad, and high inflation is deemed to be very bad as well. And so by setting a 2% target, it reduces the chance, or there's quite a big buffer between 2% and 0, and it's really that simple. By having an acceptable buffer, the probability of the central bank not being able to control it and it leading to deflation is reduced. And that's why it's 2, not 1, because it's slightly further away from 0.
No,
pretty
good. Thanks
pretty
for
simple,
explaining. I
pretty
think we
simple
all
rules,
asked that
but
so many times.
that's why.
Okay, so monetary policy again. So it has been described as a blunt tool. In your view, does raising the base rate reduce inflation?
Yes, I think it does. I mean, I think the question becomes that one about transmission, which is, how quickly does it have the impact that is desired, and also I think what is the potential negative impact of that. I mean, if you increase rates too much and businesses, get into trouble, or consumers start getting into trouble, and then there are a bunch of knock-on effects. So consumers might start defaulting on their debts. We haven't really seen that in the UK so far, although some of the credit card programs are beginning to show a slight pickup in arrears. Some of the sort of more subprime auto pools are beginning to show a pickup in delinquencies. But also you could have an impact on businesses where they may be more exposed to interest rate changes on their floating rate loans,
Yeah.
those businesses get into trouble. They're going to have to lay off staff, which means then unemployment goes up, which then sort of starts to fuel this sort of spiral, really, of consumers being in trouble, worried about their jobs, or actually having lost their jobs, not being able to pay their debts, which means that then the banks get more conservative, and it gets into a very bad place. So the central bank has to be very careful to put up interest rates enough, but not too much. But if they don't know exactly what this transmission rate is going to be, it's difficult for them to see, how quickly it's working, and this risk of what's often called overshooting is pretty high.
So do you think there's any other tools that could be used, should be used?
Not really from the central bank. I mean, the printing money, as I said, quantitative easing, quantitative tightening is one, and we should mention that we're going through a period of quantitative tightening right now because we have to unwind all of the quantitative easing that was important to keep the economy afloat during COVID, but they are pulling out that. So examples of that will be that a lot of banks took cheap loans, a lot of businesses took cheap loans from the government during COVID. Those were funded through borrowing. They now need to be repaid, and so that's going to put further pressure on the balance sheets of those businesses. And if rates are suddenly higher, they're going to need to replace those loans, which were very cheap, with much more expensive debt right now, and that's a challenge. The other tool, obviously, to impact consumer spending is taxes. But that's a political government. No, exactly. That's a government tool, not an MPC tool. But the MPC will always be watching very closely what political parties are going to be doing around tax, because they don't want to be putting up interest rates a lot at the same time as taxes are going up, because it'll have a double hit on consumers and businesses.
Yeah, absolutely. Thank you. I think I mentioned earlier, we're all looking a lot more towards what the next interest rate rise or not rise is going to be. And we're finding that the committee are giving different opinions on should we rise, should we stay. Why do you think that differs so much within the committee?
I think it's because the data is very mixed right now, and this risk of overshooting. Do we feel that the interest rate rises that we've seen so far are enough? They just need to filter through into consumer behaviour, or are they not filtering through? It's more about that there's not enough yet, and therefore the central bank needs to go further, and that's a very difficult thing to judge at this point. And the sort of the concept of forecasts or forward guidance is something used by a lot of MPC or central banks around the world. I think it's the other thing that is watched very closely is the actual statements that come out of the MPC or any central bank. There's a famous art of Fed watching, which is watching the US Federal Reserve, and people will actually go through and check individual words to see whether the words are changing in the statements and what that might mean for central bank sentiment. Okay. So there's a huge amount of science, or not sure science, maybe art to the central bank watching.
So you mentioned the forecasts and how we interpret them. Should there be multiple forecasts, do you think, explaining the different scenarios, given the uncertainty in the market at the moment?
I think it's very difficult to provide forecasts for anyone, whether you're a market participant or taking a view, or an MPC member or an economist. But I do think they're very important because it provides a view to the market and to consumers and businesses about what might happen in the future, and helps with planning. So if you're at a business, you might be pleased to see that interest rates are only going up a little bit more, and then they're likely to come down, and that may encourage you to sort of keep investing. Whereas if you can see a forecast where interest rates are likely to go up for a significant period of time, you'll probably choose to stop making that investment and delay. And that is kind of what the central bank's trying to get through that policy, is to impact the consumer and business behavior. So I think the forecasts really help them drive that behavior. The market will provide its own view of forecasts. So we often have in previous sort of webinars have talked about swap rates. You know, the swap rate is what the market expects the average central bank rate to be over the next 2 years, 5 years, or whatever the swap rate is. And obviously you can look at the Bank of England forecast and see what they think the average central bank rate will be over the next 2 years. And those two are not the same, but very much the market will look at what the central bank is saying and will include that in their forecast or in their pricing of swaps. Yeah. And swaps are key to price mortgages and all kinds of savings as well.
Brilliant. Thank you very much. Okay, let's go back to inflation and why it's so important to the UK mortgage market.
It's important for a number of reasons, actually, and I think we need to look at both wage inflation and price inflation here. So wage inflation is key because, you know, if customers can afford, you know, are earning more, they should be able to afford more and can get a bigger mortgage because of that. So that's a positive in terms of wage inflation. Price inflation is a negative because that is, you know, everyone you know, listening to this will know, you know, increasing inflation, increasing expenditure, you know, price of utilities results in, you know, lower affordability for mortgages. And then there's that second order effect that the central bank rates and the central bank's forecasts and swap rates will affect the mortgage rate, and that also impacts affordability. So it's fundamentally important to the amount customers can borrow. Mm-hmm. We also see that over the longer term, house prices or house price inflation and wage inflation are very highly correlated. It's probably one of the best predictors.
Brilliant. Thank you. Given that capital markets are sensitive to economic data releases, which can also impact pricing very quickly, what can advisors do to support and reassure their customers at this time?
Yeah, I think this is, you know, really, really difficult. You know, we talked about how difficult it is for the MPC, and that's made up of, you know, incredibly experienced economists and, you know, and central bankers, and you know, they found it very difficult to predict where inflation will go and where interest rates will go. So, what is the chance of sort of mere mortals in the capital markets or the mortgage market? So, I think one thing that can be said is by looking at the central bank forecasts, it's possible to say to a customer coming in, well, when a customer asks, what are interest rates going to do? Well, at least you can say, well, the Bank of England thinks interest rates are going to do the following. Mm-hmm. And you can get that from looking at their most recent you know, output of the Monetary Policy Committee meetings. Also, I guess the other things, you can look at the swap rates, and that's where they're expected to be on average over the life of the term that the customer's taking. So you can say, on average over the next 2 years and on average over the next 5 years. Swap rates are not easy to get, but they're getting easier. So you just go onto your web browser and search engine and look for 2-year GBP swap rate or 5-year GBP swap rate, and those prices will come up. They tend to change every day rather than by the minute that sort of market participants will see, but that still will give you know, intermediaries a good view of, you know, whether those rates are changing and also what the average rate is predicted to be. So I say that's a pretty good place to start.
That's good, and I think that's a pretty good place to end as well, actually, Alex. I think that's a top tip, and what we'll do is we'll make sure we provide the link to that so any brokers listening can look on the website and look at swap rates for themselves every day. So thank you very much, Alex, for joining us today. I hope everyone's really gained a lot from this. Thanks very much.
Thank you to Alex for taking the time out to give us the inside scoop on what happens at the Bank of England and the role that they play within our industry. If you did miss any moments throughout the video, Alex's video, along with the webinar today, is being recorded, so it will be emailed out to you later on today. Alex and Francis did mention a link to swaps, which will also be made available to you in that email, along with your CPD certificate later on today. We will now head over to our final interview, discussing how the industry can shape the future, with Andrew Montlake, affectionately known as Monty, best known for his roles as MD at Coreco and more recently chair at AMI, the Association for Mortgage Introducers.
Thanks, Eloise. Monty, welcome, and we'll get straight into it. I guess looking forward, do you think the market will settle and sort of come back, or do you still think it's going to be a bit of a bumpy ride?
I think undoubtedly it's a bit of a bumpy ride for a while. The market will come back inevitably. The question is when. As I say, I think the last quarter of this year into next will be a bit better, and it will improve. But we are looking at a mortgage market that is smaller this year and slightly smaller again next year, maybe than it has been the previous couple of years.
Yeah, absolutely. Next question then. You recently appeared on the Martin Lewis Money Show Live. How did that opportunity come about, and what was the experience like, and what impact do you hope it will have for brokers and customers?
Yeah, it's a bit of a whirlwind being on that show. Martin is a tour de force, and he really knows his stuff and is excellent. I've been lucky enough to do a couple of his radio phone-ins in the past. Just from the work I do with the PR, the more you do, the more opportunities you get. And they kindly reached out and gave me the opportunity a few months back and invited me back last time. So it's very interesting, and actually a lot of the words of wisdom that Martin gives is really important for the mortgage broking community, because he does have a phenomenal following. He does support mortgage brokers, and for someone like him to say on primetime TV that you should go and talk to a mortgage broker is extremely powerful. So I think there'll be a lot of mortgage brokers' phones that will be ringing in the week after that is because of that, but they might not realise it's because of that. So it's a great opportunity for brokers, and it really is important to have the backing of someone like Martin.
Brilliant. I suppose that shows the value of consistency, certainly with your PR work, in order to get those opportunities. The mortgage charter came up on the show during the interview with the Chancellor. Just wanted to ask, what is your view of the mortgage charter?
Look, I mean, the concept behind the mortgage charter is right, isn't it? It's about trying to help people, so that's fine. I think a lot of actually the stuff that's in the charter, the good lenders were doing anyway. There are a few changes to that, and it puts it into greater focus for some other lenders. It is voluntary. It's not actually set in stone that every lender has to do every part of it, but the good lenders are doing those things anyway. So there are some good things. There are some difficulties around it, certainly around every lender having to offer something 6 months before your rate expires, and then potentially making sure that clients know about any changes within that rate if it gets better up to 2 weeks before. There's a few question marks over the nature of advice, if that's come from a broker, are lenders coming back to brokers and giving them the opportunity, etc., which is very, very important. And if they're not, are they potentially changing some of the advice that a broker is given, which they have to be wary of? So the crux of it, I can see where it comes from, and it means well, but there are some things that need to be looked at a little more carefully.
And I guess from the Kensington position, we are one of the few specialist lenders to sign up to the charter, and we completely agree. Anything which I guess helps the customer pick up the phone to either their lender or a mortgage broker is certainly positive.
Yeah.
Sticking with politics, you recently attended a meeting with some Labour MPs, I believe, and other industry representatives to discuss the challenges of the mortgage market. And obviously I wasn't in that meeting, so what insight can you provide to those that are watching this about what happened behind those closed doors? You know, why did it happen, and what impact might happen downstream?
I think this was about the Labour Party reaching out, and as for myself personally, as Amy as a whole, we're obviously there for any party to reach out and talk to, and we'll talk to everyone. It's a bit of a shame that it's the Labour Party who've come to us first, rather than a government who's been in power for 13 years. But they came to us and wanted a representative of a lot of mortgage brokers around the country. We tried to get together as diverse a group as possible in such a short space of time, because these things normally happen very quick, and you're never really sure whether it's actually going to happen or not, because it could change last minute. But it was really good. It was really insightful, and you know, Rachel Rees and Lisa and Andy were there, and actually from a personal perspective, I was impressed with both of them in terms of the grasp they had on the situation. There were some things obviously that will remain behind the closed doors that we were talking about, but it was generally about the market and the mortgage market, and about buyers, and how there are certain challenges at the moment in terms of rate rises and what effect that is having on people, and are there policy ideas for the future that we can put forward that potentially will help to guard against this type of thing happening again, and basically ensure that the housing market continues in a much more acceptable way. So it's not just about everything's about first-time buyers or everything's about renters. It's about, for me, it's very important to, and I made the point about you need to have a healthy housing market. You need a healthy buyers market. You need a healthy private rental sector, and you need a healthy social housing sector. And you probably need a very long-term plan, rather than very short-term plans and a housing minister that's not at the top table and in situ for just 5 minutes. So we talked about a whole range of things, from shared ownership to the private rental sector, to first-time buyers, to people on struggling with higher interest rates. So it was a good discussion, and all we can hope is that there's an introduction there. They know where we are if they need to talk to us, if they do get into government, and hopefully there are some good, sensible ideas there that will form policy making of the future.
Yeah, brilliant. It certainly feels like a productive meeting, because you know, everything's all interlinked, isn't it? Politics, mortgages, lenders, brokers, all trying to work for the customers. So it'd be interesting to see if there's more of those types of meetings, even, you know, depending on who gets into power. It would be interesting to see if there's more collaboration moving forward. Supporting our brokers at Kensington is a real big focus of ours. And one of the ways that we do this is continue to offer a minimum of 48 hours notice on standard product withdrawals. And I know that sudden product withdrawals are challenging on both the practical and the human level for brokers. I know you've commented on this before, but I'm just really interested in what your view is here, and what could some lenders do differently?
I think it's been a really interesting debate, this, and whilst as brokers we do understand that, you know, we've had a couple of real shifts in swap rates that have been almost unprecedented, really, in such a short space of time, certainly for a number of years, and that causes lenders certain issues and pricing issues, which we all get as advisors. I guess where the frustration lies is that the way that some lenders handled this could have been handled better, and there seemed to be an expectation that, oh, don't worry about brokers, they'll be able to cope with it, they can work till midnight, they can do this, they can do that, and sort of forgetting the stress and strains that has on the broker community, all of whom are dealing with not just the lenders but also the clients at the end of this. And sometimes there seems to be a bit of a forgetfulness that actually there's a client at the end of this who doesn't have time to make a decision on what's one of the biggest, most important decisions of their life. So all we're doing is looking at how can lenders do things a little bit differently. Are there ways they can manage their pipeline a bit differently? Could they have earlier product meetings where they can give us more notice? Can they give us more notice? We know it's not always going to be perfect. And we also know that if you're a really big lender, those changes can be really dramatic and have a real incapacitating effect on your service levels, and on, you know, what you don't want is millions of pounds going out the door on loss leading products. We do get that, but it's about trying to find a better way to do something, whether that's using technology, whether that's using, you know, some lenders, for example, if you do an agreement in principle, it gives you a certain amount of days to submit it. Other ways we can do that. So it's about brokers and lenders really working together to make sure that we learn from this period, and if something like this happens again, it doesn't have the same dramatic effect that it does on the lives and the mental health and the well-being of not just the lender staff, but also the brokers and ultimately the clients.
Yes, it certainly feels like there's more that can be done despite the challenges there. So hopefully we'll start seeing a bit more of that. And I guess finally, in your view, Monty, a bit of an open question this, what are the biggest opportunities out there in the market, and what do you feel are the biggest threats?
Start with threats, because I like to end on opportunities.
I should have asked that the other way around.
Yeah, it's quite interesting actually in terms of threats. Obviously, the market itself is a threat, and sometimes you have to be careful what you wish for as brokers. I think a big threat is that the market doesn't recover as quickly as we hope, and we're all doing product transfer business for a long time yet. I think, bearing in mind what I've just said about lenders and them helping, and actually brokers trying to be as understanding as possible with lenders, I think actually lenders need to be understanding with brokers around product transfers and the amount of work we do, and it's really important to support brokers in that. So I'd like to see some lenders look at their product transfer prop fee pricing and make that a lot more equal, because the amount of work a broker is doing at the moment, and they're redoing that work 2 or 3 times if they're doing it 6 months out from completion, is really important. So that whole market issue is a threat. ChatGPT and AI is really interesting. I know we've been down this route before with things like robo-advice, and we're all going to be out of business. 10 years ago, we all thought that. But ChatGPT and all of that AI seems a little bit different. And I think a lot of brokers need to look at that and look at the technology there, and see where they can use it as an opportunity rather than just ignoring it and it becoming a big threat. So the changing market and changing consumer behaviour is quite interesting. And just for the market as a whole, it needs to adapt. We need some more interesting products. We need some more lifestyle products. We need some more longer term products, which aren't just the traditional 10, 15, 20-year fixed rates with big repayment charges, etc. We need a more diverse set of products. But saying that, you know, with we have seen some brokers leaving the market, sadly, because it is tough at the moment this year. But there is opportunity for others. It's a time to look at your businesses, look at where you get your leads from, and how you deal with your clients and your introducers and your client journey and your relationship with lenders, and really build on it. Use the basis of the consumer duty, actually, can be a useful tool there. So for brokers who can talk to as many people as possible, always provide advice, whether it gives them money or not in the short term, those types of brokers, like a lot of us who came through the credit crunch a decade ago, are going to stand themselves in good stead for the future. There's always opportunities because the market will come back, and we all have to be ready for when it does.
Yeah, brilliant. Some really interesting answers there. Appreciate your time today and the answers that you've given. Hopefully the brokers that attended found that interesting and valuable. Sadly, that's all we've got time for. I could speak to you for hours, Monty, so thanks again. And if we can just now pass back to Eloise.
Thank you, Monty, for providing that excellent insight into some of the governmental conversations that you've been part of and the role that you and also all the brokers listening and watching today play in shaping the market and the future of this market as well. Now, let's move on to the very last session of the day where my boss, Francis Cassidy, is back on screen to discuss the latest news from Kensington. So over to you now, Francis.
Thank you very much, Eloise, for that third and final introduction. We've spoken a lot today on this webinar about the challenging and unpredictable market that we find ourselves in at the moment. So I thought it'd be really great just to end on a high and highlight some of the new initiatives that Kensington have delivered over the last couple of months. So firstly, I wanted to talk about new products, and I'm going in a slightly different order to here. So the current environment that we're seeing and the cost of living crisis means we're seeing more customers with blip on their credit profile. So we want to offer new products to support them, and that's where Resi 12 comes in. Really supports first-time buyers and complements our existing Resi 6 product. We have also launched our shared ownership remortgage. The market is just getting bigger and bigger for shared ownership. And with the demise of Help to Buy and being a responsible lender, we wanted to offer this option so customers can continue their shared ownership journey. And then lastly, we've launched our 3-year fixed rate. So we've had so much feedback from brokers and customers about having an option between the standard 2 and a 5-year, which I know we've spoken a lot about on today's webinar. We launched that a few weeks ago, so hopefully you'll be able to use that and offer that as another option to your customers. We also joined the Mortgage Charter. So we're actually really pleased to say that we were the first specialist lender to sign up to the Charter and be able to help those customers that need help in this environment. We're pleased to report that actually the volumes are very low, so we've not seen a huge take-up, which is hopefully a positive indication of customer sentiment at the moment. We also launched our new Intermediary website. We've updated lots of the pages to make it easier for you to navigate, including our BDM finder. You can access our service levels that are live and up to date, and product details and new product launches, just as I've mentioned just before. We also have our webinars and blogs, so if you want to sign in and listen to any of the webinars that we've done previously, you can do as well. And lastly, I just wanted to talk about service. So we've hit a new milestone on service, 20 months of day one underwriting, which we're all really proud of here at Kensington. We've also adhered to our promise of giving 48 hours as a minimum on our standard product range for product withdrawals. Again, something that we're all really proud of. Thanks once again, and I'm going to hand back to Eloise.
Thank you, Francis. And I just wanted to share my appreciation for all of you joining us here this morning as well. We wouldn't be the lender that we are without your business and support. So thank you for all of the cases that you've submitted to us so far this year and joining us today. Our commitment to our intermediaries is still our #1 priority, and offering you fast service levels, plenty of time on product withdrawals, as well as competitive rates is absolutely key. So on that note as well, please do keep an eye on your inbox for the launch of our new reduced rates and special product launches across both residential and buy-to-let going live tomorrow. As I mentioned at the start of today, to make sure we're talking about the right topics in these sessions, your feedback is hugely appreciated. So when you exit the webinar today, you'll be presented with a short survey. So please do take the time to complete this and let us know what you'd like to hear about next. Like today's webinar, it has been created on the back of your feedback, so it does go a long way. If you could also head over to our LinkedIn and our new Instagram page and follow us on there to receive all of our latest webinar news and product updates, that would be amazing. The webinar today has been recorded, so if you have missed any moments or wanted to share with your colleagues, we will make that available to you later on today as well.